Thank you everybody for coming today. My name's Gareth Hector, I'm Head of Marketing here at Westwood. Lovely to see such a full room. Hope you've enjoyed the bacon. I'm sure it's content that's brought you out, not hot food. We've got a really interesting hour and a half, couple of hours for you. My colleague's going to talk you through a look at decommissioning from a demand and a supply point of view. We're going to be taking some questions at the end of each session and then a fuller Q&A at the end. But just a quick recap, what you're here for. It's the first session which we're kicking off in just a moment. We'll have a quick scene setter before we look at the demand side. Short coffee break, 20 minutes. I'll ask you to be back for past, if you wouldn't mind. If you didn't manage to grab any food or coffee, it will be there at 10 again. Before we roll into the second session, we start to look at the supplier side of things. And then we'll be wrapped up by 11:30. So if anyone's on a timer on the car park or parking, you should be within your hours. For taking questions today, you can scan the QR code that's on your table, or do please feel free to interact with us, put your hand up. Always look forward to an engaging session where possible, but if you'd rather just submit your questions via your phone, you can do that as well. It's great to see a lot of familiar faces as usual. I think this is the third or fourth time now in the third or fourth year we've run an event here at the Chester. So I know a lot of you are already familiar with what we do. I will not go through this slide in detail. What I do want to highlight is our capabilities across the upstream energy sector and the fact that we do pride ourselves on being specialists. The quality of what we do is absolutely paramount, and the flexibility of what we do, either through research and products or through commercial advisory services. But today, the content you're going to see is essentially based on these research solutions and applications: Atlas, Subsea Logics, Platform Logics, and Rig Logics, as well as commercial advisory. You can get information on all of these today. We've got a team in the room. There's various points you can pick up stuff as well. And excitingly, coming up in the near future, as one would hopefully relate to, we have a new decommissioning module, which Yvonne will speak about briefly later on. And that will be coming out in the near future. Watch this space. In terms of who we have today, Emma's going to kick things off in a moment with the scene setter before Yvonne and Glenn will come up for session one to talk about the demand side. Have the coffee break and then be delighted to introduce Teresa up to the stage to talk on the rig side. And Nick, he's looking a bit pasty in that photo, but he is here and he does have a face before Nick then comes on for the final part of the day. Short disclaimer, and that's it from me. Just to say, no fire alarms tests are due. If you do hear one, it should be for real. Not that we want it to be for real, but it would be for real. Fire exits, etc. Last point, if you wouldn't mind just having your phones on silent as usual. That's it. Thanks very much. Emma, if I can welcome you up.
Thanks, Gareth, and good morning, everyone. It's lovely to see so many people here. A good packed room, which is always good. And I believe we've got a number of people online as well. So welcome, everybody. So before we dive into the crux of the decommissioning presentations that we've got for you this morning, I'm just going to give you a quick scene setter of the state of the UKCS. So these are our conclusions from last year's event. So a year ago, we presented on creating value in an evolving UKCS, where despite the ongoing political and fiscal uncertainties, the industry remained an important part of the energy mix, and the UK still presented a number of opportunities to both E&P and the supply chain companies. For E&P companies, we highlighted that significant contingent and prospective resource still remained, and companies still had the appetite to grow their positions through licensing rounds. Another opportunity highlighted was the potential of electrification of oil and gas hubs to not only reduce emissions, but to extend the life of hubs. And although North Sea decommissioning was not new last year, it was becoming an increasing part of the energy transition as the UK turns to other energy sources and looks to repurpose existing infrastructure. And the energy transition was in full swing. The offshore wind industry continued to grow and set ambitious targets. And we also were seeing the development of 2 new industries in CCS and low carbon hydrogen. So a year on, where are we and what is the outlook for the UK CS? Obviously, since the last event, we've had a change in government and overall fiscal instability has somewhat exacerbated. Much of the previous slide still runs true, but we can see here I've got just a few charts that are just showing the state of the nation really, with production declining at a rapid pace, with very little in the development hopper and little appetite for exploration activity. So all of that really doesn't bode well for arresting that production decline. A number of companies have cancelled or deferred projects. Companies are rationalising their portfolios, and exploration activity remains at a low level. So undoubtedly, investor confidence has continued to be hit hard, and companies are assessing their options. So we can see down the middle that there are still opportunities to try and extend hub life or to repurpose infrastructure. But the question is, do the companies actually have enough drive, enough appetite, and will they be encouraged enough to drive any of these opportunities forward, or is decommissioning inevitable? I'm not going to go into too much detail on this slide because it is pretty busy, but what I'm trying to highlight here is that these opportunities are still there. Westwood estimates that there's 7 billion barrels in undeveloped discoveries and 14 barrels of oil equivalent in risk prospective resources, with much of this resource already on licensed acreage and also within tieback distance of existing infrastructure. However, unlocking any of this will require further capital spending, which is only possible in the right investment environment. Other blockers in untapping this resource include the proposed licensing ban and the operational life of existing infrastructure. Over to the right, I've just put a chart in there of the potential CO2 storage profiles with all the different CCS projects that are being proposed or underway. So prior to any decommissioning planning, operators must evaluate the potential for repurposing their infrastructure for alternative uses such as CCS projects. The CCS industry is still in its infancy, and although interest in carbon storage licenses has been high, progress has been slow, and we are yet to see large spend on CCS projects as companies assess the economic viability of them. Despite this, there is undoubtedly a huge opportunity for both E&P companies and the supply chain in the industry. Several of the CCS projects highlighted here will be looking to repurpose infrastructure. But this does not come without its challenges, and companies will need to validate the suitability of them. So we turn our attention to decommissioning. It's already upon us, we know that. The map on the right is sadly showing the rapid loss of hubs in production. So you can see it's going from present day through to 2040 and showing the hubs that are still in production at that time. There are currently 75 hubs in the UK that are currently producing or under development. And based on current firm investment plans, Westwood forecasts this to reduce to 40 by 2030, 18 by 2035, and just 4 by 2040. Decommissioning is a costly and complex task, and over the next 10 years, we forecast that over $25 billion will be spent on decommissioning activities. The North Sea transition deal pledges to ensure that at least half of this spend on decommissioning activities go to the UK supply chain. And therefore, this presents a huge opportunity for companies in the UK to become global leaders. The forecasts seen here on hub closures and on decommissioning spend are obviously subject to change as operators offer to defer decommissioning projects to either try and maximise the recovery of their hubs, or repurpose that infrastructure, as we saw on the last slide. But companies may also look to bring hub closure forward or defer decommissioning projects in the hope that they will become more efficient and cost effective. Regardless of some of this uncertainty on timings, decommissioning of the North Sea is going to be a huge industry and a very busy one in the next 10 years or so. The UK is expected to account for around 30% of the global decommissioning market in the next 10 years. So on that note, I'm going to hand over to Yvonne and Glenn, who are going to dive into the demand for decommissioning in the UK, including what is coming, when will it happen, and who will be responsible.
I don't need to go. Okay. Thank you, everybody, for attending today, as Emma said, and welcome. I don't know many of you in the room. I do know a few. Please don't heckle the ones that I do know well. And what my colleague Glenn and I are going to cover is really trying to answer those questions around the what, the when, and the who. So the decommissioning demand. We're going to do that by looking at information that we've got from our sister products, which is the Subsea and Platform Logics products, and looking at the well information that attaches to our hub models and our economic modelling. The what is fairly straightforward. The who, again, pretty firm. You know who the operators are, you know the participants. The when is the big question, and that is the crystal ball kind of question that I would love to stand here and say I knew exactly what was happening, but I think, as each and every one of you in this room does know, that there is no crystal ball. There are a lot of companies out there who have their own agendas, and I don't mean that in a negative way, their own strategies, their own interests, and their own appetite for further investment, their own economics in terms of what their price assumptions are, their own view in reducing operating expenditure going forward, and also with regard to how quickly they want to get after decommissioning and allocate the decommissioning spend. So there's a lot of variables there. So what we're really focusing on today is using our economic modelling to give you line of sight in terms of what our economic COPs are for the hubs, and therefore give you a view on what's coming up and when that might be coming up. Now, each and every operator, each field will have a different timeline for well abandonment, infrastructure removal, etc. But before I launch into the when we think hubs and fields are going to cease, I wanted to give you a little bit of background in terms of how we do our modelling, okay? So like many market intelligence companies, we look at production information, historic production information from the NSTA, from NOD, from other government sources. For the fields, we look at publicly available information, and we look at information we receive from companies and operators. Now, we apply that to our economic models, which are designed to be at a hub level. Now, what we mean by a hub is it's the processing facility. So the Alwyn North, for example, is the processing hub, and the underlying fields are the Duras, the Dunbars, the Nuggets, well, be it ceased, the fields that tie back to that. We apply an operating cost that is representative of that processing infrastructure, and that is prorated out to the individual fields based on production per contribution to that processing facility. We then run our models behind the scenes at what our base price assumptions are, put our price assumptions there for reference. And then we run out the models to give us line of sight in terms of what the economic COPs are for those fields and hubs. So when a field falls down, the hub COP will pick up the field's operating costs, and then the hub will effectively fall over economically to close that hub. Top left-hand side there, if this works, that is our base case. So this example is a real example of a North Sea field. I'm not going to say which one. We will build in a manual uplift, production uplift, based on the information available. In this case, it's 2 infill wells that are planned to be drilled, possibly. And that field is running out to, I think it's 2032 in this example. Now, we can flex the operating costs, we can flex the price deck over in our Atlas product. So we build this behind the scenes And then in our output on the Atlas product, clients can actually flex. So they can reduce the operating cost by 20%. You can use your own price decks. Here we're going to do a lot of comparisons with the low and the high price decks here. But what we do at this point, well, shaky hands, is that once we've got the manual inputs there, we create an automated decline curve for that future production. So what that allows us to do is that when we change these parameters, it changes how long that economic production could actually go out. And that gives us the opportunity to, from the valuations point of view, look at, the future valuations, look at the value of adding tiebacks to extend, a field tieback to a hub, for example. And conversely, the low case here, see what a change to the economics will do in terms of when that field could COP economically. And in all cases here, I'm going to keep using the word economically because some operators and companies may actually choose to, based on their strategy, run uneconomically. And that's all determined on a case-by-case basis. So here we can see the impact quite clearly in terms of the impact that the different price scenarios are having on this particular field. Every field's different, and generally, we actually find that, really 0 to 3 years is probably a bit more common when you're flexing these. But when you think that the future abandonment spend, more than half of future abandonment spend is going to be in the next 10 years, changing a COP by as little as what might sound as 1 or 2 years can have a huge impact in terms of future tiebacks, getting beyond the windfall tax, and even changing the future decommissioning activity. So sorry to spend a little bit of time on that, but I really just wanted to give that little bit of background so everybody understands what we're talking about when we go through these numbers. So because we had this valuations tool in Atlas, and because we've got the products that have lots of infrastructure information on subsea equipment, we've got information on the platforms and platform logics and the facilities, kind of had the light bulb moment that what about if we attach all that infrastructure information to our valuations piece so that people can actually, when they flex what the field COPs are going to be, they can actually see what's attached to that. So you can actually see how many wells there are for maybe if you're interested in rigs, where the subsea equipment opportunities are. And that's what we're building with the decommissioning module. And hopefully we'll have that at least within the next, well, definitely within the next 2 months. So if anybody is interested in that, please see our sales team, come and chat to me. We're in the process of developing it. So if anyone's got any burning questions, desires, things they think should be included, please let me know. We're always looking to make this fit for purpose for the sector. So now moving on to looking at the what in a little bit more detail. So the chart here, and I'm going to step out a little bit, but I'll keep within the piece because I'm small. What we're looking at here is the number of hubs that could be ceasing in the UK. So again, this is the processing facilities. It's not the number of fields. Every hub has a different number of fields attached to it. So the shapes of the graph can change. But what we're trying to demonstrate here is just looking at the history of COPs, the cessation of productions, and our view in terms of what's happening. Now, as you can see, post-2014, step up in decommissioning activities. And the sector's really gotten after that in terms of chasing the business. What we're actually seeing now is in the next 10 years in the UK, almost doubling of activity within the next 10 years. It's very powerful. I've also included Norway, and this is the only slide where we're including Norway in the piece, but I think it's important to recognise that we all know that Norway's got a very different investment sentiment in terms of progressing its sector. It's in a less mature area than the UK. And there's a huge opportunity in Norway. So as theoretically our decommissioning programme ends or ramps down, we will see a pickup over in Norway. We're mid to late 2030s, we're going to see the ramp up of Norway getting focused on decommissioning. So if what we learn now, we can look to transfer over to Norway. And there's like $55 billion worth of decommissioning activity, which we forecast for Norway. Now looking at a flex, and we're looking at the high case piece. The lighter chart is looking at how that trend changes with our high oil price And as you can see, and as you would expect, you can see the number of hub closures moving to the right. And in fact, this is probably a slightly more manageable trend if you're looking at it. So because the next 10 years are looking to be particularly active, we wanted to break out just a little bit further the hub COPs on a year-by-year basis. And what we have here is, you can see it becomes a bit more messy. I can't think of a cleverer way of saying it. It's not an organised kind of decommissioning programme, and it's not very easy to kind of support in terms of what and when that activity might happen. Looking at the high case piece, it actually looks, if you were drawing a picture from an NSTA perspective or a UKCS perspective, that you might actually prefer to be looking at this high case price, where it looks like a much more manageable level of activity going forward. And conversely, if we had another oil price crash, if things got worse, what would the sector look like? We'd look at economic closure of a lot more hubs, a lot more quickly, and therefore a less manageable scenario. So carrying on with the what, and now breaking it away from the fields to, breaking it away from the hubs and moving on to the fields, what we're looking at here is just trying to give you a little bit more granularity. Again, I'm too short to see what's happening. Looking at the what. So looking at the number of fields, and these are the fields that are attached to platforms and the subsea fields and the regions that they are expected to be in. Well, they are in, not expected. And on the right-hand side, we just wanted to break out some of those hubs. So we know that $25.5 billion it could be spent in the next 10 years. So where is that money likely to be spent? Which hubs are looking like it? Now, not too many surprises for some of the hubs that are named here, but I do want to caveat that this is our current view. So we update our modelling based on the latest investment plans. So we've stripped out a lot of wells, infill well programmes that have been not included. What I should have also mentioned is that we're also not including near-term developments in our forecasts. Now, what we mean by a near-term development is, for example, think of Ocambo. Crikey, that's probably quite a good one. It might be in the near term, it might not. We don't know the timing. A certain level of uncertainty. I didn't want to confuse issues by concluding near-term developments in there. So again, they're another factor that can impact, when these hub closures could be. They are an opportunity. So aspects such as infill drilling programs, 1 or 2 wells can make a huge difference in terms of some of those COPs. And then there's some certain hubs like Montrose and Lagan, which have got pretty reasonable projects that timing is a little bit uncertain on, so not currently included in our models. So that's impacting the potential decom spend in the next 10 years. And then also there's facilities such as Le Mans and Morecambe, whereby some of that decommissioning spend may not happen in the next 10 years because they're going to be looking at repurposing a lot of that infrastructure, or some of that infrastructure for CCS. So again, taking another layer of granularity down, what we're looking to show here is some of the platforms that are associated with those fields and those hubs that are going to be COPing. So this is taken from our Platform Logics database, and some different colours here just to really confuse you, I suppose. The medium platforms, size platforms, all the platforms are sized according to weights of topsides and jackets, by the way. So what we can see is a lot of medium platforms. As you would expect, if I explain this, a lot of these platforms are the small newies that are associated with the Southern North Sea infrastructure. They're the wellhead platforms that we have attached to the big processing facilities. They're the riser platforms, etc. So high in number, fairly simplistic. The actual big old beasts, the processing platforms, are these ones in the slightly darker bluer colour. So as you can see, again, for the eagle-eyed amongst you, whereas we had the peak hubs ceasing in 2028 and 2030, the actual infrastructure associated with some of those hubs is peaking at different times, and we're looking at, those that are ceasing in 2030 have actually got a lot of, is it 2030, 2029, sorry, I've got a lot of platforms associated with it. Yeah, slightly different sort of ways to look at the data. And here I wanted to just touch on the age of the infrastructure. And I've deliberately used cars so that you can have a little bit of a break, and it gives you a break from the charts. A lot of these platforms were put in the 70s, were installed in the 70s. Or some of the old platforms were installed in the 70s. And there's been various generations of processing platforms and wellhead platforms, etc. since. And many of these platforms that were installed in the 70s and the 80s were designed with 25, 30-year life. They've already gone well beyond the length of time we expected them to run. And they've done that by care and attention and maintenance and investment. So I use the analogy to a lot of my colleagues of it's like trying to run an old car. So imagine you bought a Cortina or a Capri, and I'm of that age that I had friends, brothers, etc., who had these cars. And the love and the care that you gave that car over those 50 years, and how well it's expected to run out to the next 10 years potentially, you know. And it changes because somebody could have a car, be very interested in it, and then put it in the garage and maybe just get it through its MOT every year. And then a new owner comes in and invests and upgrades, and it can run well beyond its design life. But it's more challenging. And you can imagine if it is like you're trying to run a Cortina or a Capri, it may not actually be cost effective to keep that running. You know, the maintenance costs are very high. Trying to get parts, if anybody's trying to look after an old platform and the compressor system that was put in back in the day, getting the parts for that can be extremely challenging. And also bringing those emissions down, you know, bringing those emissions down so you can actually run that car or platform. The challenges are there, but we as a sector are actually doing it. And these platforms have run out this far and probably can run out another 10 plus years. And now taking it down to a next level and looking at the wells. And with around 50% of abandonment expenditure associated with the wells P&A activities, it's important not to exclude that. So what we're looking at here is the number of, on the left-hand side, we're looking at purely the number of well bores becoming inactive by COP year and the number of associated fields. When we talk about well bores, we are literally talking about well bores, not well slots. The other caveat here is that we're not including the suspended wells and partially abandoned wells in this data set. So these are the kind of operational wells. So as you can see, again, the trend is slightly different in terms of the COPs because the well numbers are different for every field, not too surprising. On the right, just looking at the subsea and platform wells split by area. And in the centre here, trying to put some costs against the well bores. So we're looking at the cumulative well bores, assuming we're not decommissioning them as we go along. We just let them not fall over, but cease, and the well bores stay static. This is the cumulative well bores over time. Now, using information from the NSTA, and it is great that they put out such detailed benchmarking information, looking at the well bores, what we've done here is just taken the average P50 well bore spend for the platform and subsea wells and given the P50 case for P&A projection. And it's about 13 billion, which seems quite manageable. But if we look at the P75 numbers, which were included there, so for reference, it kind of made me go, with 20 billion, we've got a $20 billion increase if we lend more to the P75 case rather than the P50 case. Why would that be? Especially when you think the change in subsea well cost is 9.8 million per well in the P50 case, and it increases to 14.5 million for the subsea well in the P75 case. The platform case, however, it's 0.5 million, and that increases to 8.1 million. The reason for that is that not all platforms have the luxury of having their own derricks, their own drilling facilities, their own platform crews, which can ramp through these on top of any other work that they've got ongoing on the platforms. You might need to bring jackups in. Then we're looking to the rig market, we're looking at contracts, we're looking at additional time to get there and move. So it's quite a big disparity in terms of that platform P75 well case, and that's the impact when you look at it on a cumulative basis. So because of that, and this chart can be confusing, so I'll apologise right now. What we tried to show was the duration and what the impact would be of not keeping on top of our well P&A abandonment programmes. So again, using NSTA report information, and this one is the UK Decommissioning Cost and Performance Update. They talked about an average of 80 wellbore P&As for subsea wells and 140 P&As for the platform wells per year. And as you can see, if we do, if we do keep on top of that, within 5 years, we're getting on top of the subsea well abandonment, and within one, it probably wouldn't be one, but within a couple of years, you'd be managing the platform wellbore P&A on a UKCS perspective. But what if we didn't? What if there was only 60 wellbores P&A per year, and 62 wellbores was the forecast, or what they expected to be abandoned for subsea wells in 2023, and 110 roughly in 2023 for the platform wells. So as you can see, it takes longer to do. And if we actually only achieved what was, the 60 and the 40 and 80 wellbores that were actually conducted in 2023, you can see that the backlog in terms of P&A activity is pushed right out to the end of the decade at least. So, huge amount of work, and hopefully I've covered the what is needing done, and now I'm going to hand over to Glenn, who's going to talk more about the who, and who will be spending the money.
Thank you very much, Yvonne. Am I live on the mic? Cheers. Yeah, thanks everyone for coming today. Appreciate your time. I just first want to, kick off with that headline number on the screen, right? UK companies have a $47 billion remaining ABEX bill. Now that number is kicking around, obviously, at a period of fiscal instability, fiscal uncertainty. And while in obviously an ideal world, you'd want an attractive fiscal regime that attracts investment into the UK, allows companies to push out that decommissioning liability as far into the future as possible. We are where we are, right? So we sort of want to highlight today that $47 billion is not a liability. It should be seen as an opportunity, right? It's an opportunity to the service sector. If you're in the rig game, if you're in the supply vessel game, support vessel game, you guys are going to be competing for the contracts that these operators are going to put out for tender, right? So we sort of want to just show how that opportunity is panning out over the course of the coming years. So the chart on the left-hand side there, that is just showing the ABEX spend on an annual basis, split by operated and non-operated. And as you can see, the bulk of that ABEX spend, i.e. 50% or over 50%, is expected within that next decade period. And of that total, 75% of it will come from operators. The two charts on the right-hand side are just showing, again, that operator split, but we've brought in two time frames here. So the one at the top is just showing 2024 to 2033, that's i.e. the next decade, and the one at the bottom is just beyond that. And as you can see, the operated spend drops from around 80% in the next decade to around 67% in the decade, in the time frame beyond that. And that alludes to what Yvonne was talking about before, right? A lot of that looming decommissioning bill in the coming years is coming from, the big hubs, the 40s, the Ninians, the Cormorants, etc. The operators of those assets tend to have usually large legacy stakes that they haven't really divested over time. And as a result of that, the bulk of their decommissioning is falling within that next 10-year period. So that was the headline picture. How does it look, or what does it look like from an individual company perspective? So the charts on the screen try and answer that question. So on the left-hand side, that is just showing the remaining total ABEX spend split by peer group. And as you can see, the majors and the large caps are dominating the picture, right? They account for nearly 70% of that overall decommissioning spend remaining. These companies still have significant stakes in some of the key operated hubs in the UK, and as a result of that, it's no surprise that they're obviously on the hook for the remaining of that decommissioning bill. And we see that play out in the chart in the middle as well, right? This is just showing the net ABEX for the top 15 companies in the UK sector, and as no surprise, the majors and the large caps are clearly dominating the picture there, but there are nuances here, right? So those majors, the large caps, they tend to have stakes in assets that are usually less mature in the basin. As a result of that, they can push out that COP as far as possible and push out that decommissioning spend as far as possible. Think along the lines of BP operating west of Shetland, the likes of Clare or Schiehallion, or Shell in the central North Sea is Jackdaw's under development as a tie back to Shearwater. It's redeployed the Penguins FPSO further north to bring the redevelopment phase on stream towards the end of the year. All that investment serves to do is push out that COP and push out that decommissioning spend as far as possible. So for those companies, the bulk of their decommissioning spend appears beyond the next decade. Whereas on the flip side, you have a group of companies that have largely been in harvest mode in the UK in recent years. So the likes of TACA, CNR. They haven't really invested in the assets to the same scale as, say, the majors and the large caps. As a result of that, the bulk of their decommissioning spend is coming within the next 10 years. Think along the lines of TACA at Bray, and of course CNR at Ninian. The chart on the right-hand side is just showing how those top 15 companies are split, but this is based on the number of fields that they need to decommission. This is at the gross level, so both operated and non-operated. And it's just to showcase that it's actually pretty evenly split between the number of subsea fields to be decommissioned and the number of platform/FPSO fields to be decommissioned with, a few gravity-based structures, albeit, they're going to require a lot of man-hours to get rid of those, right? So that's the infrastructure perspective. What does the story look like from a wellbore P&A perspective? So, I don't know if Yvonne touched on this before, but of the remaining ABEX bill, over 60% of that spend is expected to come from wellbore P&A, so it's significant, right? And of that P&A spend, 60% of the wellbores, this is wellbores, not spend, individual wellbores, 60% of the remaining wellbores to be plugged and abandoned are platform wells. Again, no surprise, some of the key hubs that have, legacy hubs that are still operating today have a fair number of well slots, fair number of wells that have been drilled over the years. So of course, it's no surprise that platform wells dominate that picture, right? And the two charts on the screen are just showing the split of platform and subsea wells for the top 20 companies, again, coloured by peer group. And as you can see, has been a key theme for certainly my part of the presentation, the majors and the large caps are dominating the picture as well. And they still operate some of the key hubs in the region, and are going to account for over 50% of that wellbore P&A when all is said and done. So we've touched on what is being decommissioned, by who and when. But I guess one of the key questions, certainly for me, is can the companies that are operating in the UK at the moment, can they pay for that decommissioning liability from the current operations? So we tried to answer that question with the slide on the screen there. So this is just showing the net remaining ABEX spend in the UK for the companies divided by their net remaining UK cash flow on a pre-tax basis. And I hate to sit on the fence, but the answer is yes and no, right? So on the right-hand side, the companies here in positive territory on the right-hand side, these have largely been active in the multiple verticals in the UK in recent years. In the last decade or so, they might have acquired assets in the M&A market in the UK. They've explored more so than the companies on the left-hand side in negative territory. They've invested in the domestic production bases. They might have brought discoveries into the development and production phase, and as a result of that, the production bases are relatively high, relatively strong, and with that, obviously, the cash flows are relatively strong in the country as well, so they can afford to pay for that decommissioning liability from their current operations. Whereas the companies on the left-hand side, these in negative territory, they're on the flip side of the coin, right? They haven't really been active in those verticals. You might have divested assets in the M&A market in the UK, like the US majors, ExxonMobil, of course, being a good example of that. They don't really explore, haven't really explored in recent years. And their assets that they hold, that they operate, they can't really compete for the capital relative to the other assets in the global portfolio. So as a result of that, their production bases are low, and they don't have the cash flow to pay for that, cash flow from operations to pay for that decommissioning liability. Now, there is, of course, one main caveat to the whole picture here, particularly those companies on the left-hand side there in negative territory. They can, of course, capitalise on that favourable fiscal treatment of decommissioning liability in the UK with the ability to, claim relief and carry back losses, etc. That is everything I had from a corporate perspective. I am now going to pass back to my esteemed colleague Yvonne, who's going to wrap up the session.
Thanks, Glenn. I could just stand and let you read it. So as we've said, and hopefully given you a little bit of a flavour and a picture of, in terms of maybe some of the information that lies behind the big numbers that ourselves, NSTA, OE UK, everybody puts out there. Huge opportunity in decommissioning. And the what is pretty much all there for the grabs. The crystal ball, we don't necessarily have, but we're hoping to give the market some tools that will help along the way. Obviously, there's always caveats to that. Investment, huge unknown. The appetite's not there, but it doesn't mean the opportunities don't exist in the UK. I think there's every field as an opportunity that could have a potential tieback, or every hub rather. Keeping the costs down, managing that P&A. That's going to be so important. It's a huge challenge. I don't know how the NSTA herds cats to actually get the operators online and make best use of the service sector. The service sector is presented with this huge unknown at the moment of not knowing when the timing is going to be, and that, this load of work is coming, when? But as taxpayers in this room, it is absolutely fundamental that as a sector we can deliver decommissioning at the lowest cost possible, because the decommissioning tax liabilities, the tax relief on expenditure impacts HMRC, and post 2030 the cost of decommissioning will be something that the politicians have to pay attention to. Please don't put that in the press. And finally, the impact of lack of investment, the impact of volatility of oil prices and gas prices, we know that, we've seen it before, but they can accelerate the COPs and the pending, the timing of that immense amount of work that's in decommissioning. And so with that, I think myself and Glenn can take a couple of questions now. If there's any burning questions in the room, we'll break for coffee. And then in the second session, my colleagues Teresa and Nick will be focused more on the supply side and looking at how the supply chain and what the trends are around that in terms of supporting this looming business. Thank you.
Do you have a couple of questions come through? I should have noticed, actually. I'm just going to stand here and wave at the camera. We've got people live streaming today. Hello, everyone at home.
I got on the other side of a balance.
Yeah, this is like the Little and Large show, to be fair. When he stood next to me, I couldn't have had another analyst more disparaging than me.
So there's no questions for me.
Couple of questions first, and then if anyone does have a question from the floor, please put your hand up and we'll come round to you. What are the reasons for decommissioning doubling in the UKCS from the last 5 years to the next 5 years?
Number of hub closures, number of fields closing. Post 2014, we saw the impact of the oil and gas prices, particularly the gas price crash with, I think the best example is when ConocoPhillips ceased production of the Murdoch Valiant logs system area. When they brought that down, a number of fields ceased at that time, but they were relatively low cost in terms of decommissioning because they're based in the Southern North Sea sector, relatively low cost, easy to decommission. What we're now seeing in the next 10 years is some of these big legacy assets. So I talked about platforms from the 70s. So unfortunately, I went to these platforms, so it's a tear in my eye. Tern, North Cormorant, Cormorant Alpha, they've all ceased production this year. They've all got subsea fields associated with them. They've all got a high number of platform wells, massive platforms to decommission. But realistically, 5-10 years ago, we were, especially in like 2017, I stood up in similar surroundings and spoke about the next couple of years being a pivot point in terms of investing and investing and maximising economic recovery, because we've got to appreciate we're a mature region, and if we don't do it now, we're going to start seeing the hub closures accelerating. So ultimately, acceleration of some of these big assets is what's driving up those costs.
Thanks, Yvonne. Another question through. What is the distinction between operated and non-operated in this context? Glenn, I think this relates to your slides. Surely all this spend is on assets that are operated by someone.
Do you want me to jump in?
True, go on, Jim. To be honest, just for context in the room, me and Yvonne have had a debate over that slide over the last couple of days, so I'll let my superior answer the question.
The amount of money being spent doesn't change. The difference is who's managing the money. The operators are the ones who are actually dishing out the contracts. They're the ones that are doing the tendering processing and deciding who's winning that business. Absolutely, the participants in those fields, a field with 3 partners in it, the operator is the one that's driving the tendering process, and they report back to the partners, and their partners will influence it. But the operator is the one spending the money in the most simplistic sense. And that's why we are, in the module, looking at supplying both those modes. So you can see the expenditure at participant levels, and you can actually see what the operators are controlling. And in all honesty, when we looked at the split of, operator spend, how much spend is associated with the operator in the asset versus the non-operator, I was personally surprised that it was as high as 75%. Hopefully that answers that question.
You did a better job than I would have done, so.
Any questions from in the room? A couple more online. Yep, gentleman here.
Colin, go ahead.
Not for me, is it?
Yeah, it's one for Glenn, actually. I mean, given the plot that you showed there, a lot of companies on the left-hand side are kind of in negative equity.
Yeah.
You think there's a real chance they'll just go bust rather than undertaking their decom? We've seen it in the past. Ardmore operator went bust.
Yeah, I mean, it's certainly a risk, guy. But as I said, the ability to carry back the losses, etc., will play its part. But yeah, certainly a risk, and certainly a risk for the taxpayer. Of course, we've had conversations, haven't we, about how much could the taxpayer actually be on the hook for. But at the moment, we haven't really seen any signs that that's going to happen. So I think for now, everyone can relax. We don't have to borrow any more money.
Yeah.
Just a quick, easy one for me to answer. Someone's asked if the slides will be available afterwards. Yes. There you go. Yep. There's my insight for today.
There you go.
One more, Yvonne.
Sorry, I think there was another couple of questions in the room as well.
Yes, okay.
Was there?
I'll come round. Let me ask this one. And then
Go for it.
The hands. It was said, as a result of EPL, the decom liability is like a herd of elephants at the bottom of an investment cliff. Does fiscal policy risk hastening?
Does fiscal policy risk hastening?
Hastening the herd of elephants, I'd say so.
Well, yeah. Companies can offset decommissioning expenditure against the corporate tax and supplementary charge, but they cannot use it to offset as costs against the energy profits levy. That's one big difference. What that means is, and losses accrued against it from historic investment, and yes, it impacts investment. I think that's the easiest way of doing it. It's we all know it's impacted investment. Impacted investment because they're getting rid of the investment allowances, which incentivise capital expenditure. And they've increased the tax rate to the same as headline tax rate as Norway. And Norway is in a significantly different position in terms of the maturity of the basin and the revenues that it can generate against its platforms.
I think also it just touches on, the amount of times in recent years that the fiscal system has changed, right? It's very difficult for the E&P companies to plan going ahead. Whereas Yvonne's just touched on Norway, that fiscal regime has been stable for decades.
Yeah.
And the only time it's changed in 2020 to 2022, was in favourable terms to the E&P companies, so they're not going to complain about that, right? So I think that constant chopping and changing of the terms is playing into the investment numbers, because it's very difficult for the companies to plan if you don't know what the long-term fiscal system is going to look like.
Thank you both. We do have a couple more minutes, so if anybody else does have a question. Yes, gentleman.
Callum?
Will there be, are you aware if there's likely to be a number of assets in limbo mode? And what I mean by that is the existing folk are finished with it, they don't want to do anything with it, it's done from an oil and gas perspective, and the regulator in its mind, her mind, thinks, hold on a minute, you can't get rid of that, we might need it, it could be handy. Somewhere down the line, who knows for what, so you can't get rid of it, so the asset is in limbo, and what happens and who pays and all of that stuff.
Ooh. Good question, Callum. I don't know, actually. It's an incredibly good question. It's the NSTA. Is there anybody from the NSTA in today? We were due to have somebody.
Oh.
Hi.
Step up to the floor.
Yes, the NSTA does, obviously, when companies want to cease production, they have to apply to cease production. They've got to put the COP applications in, and they've got to review the opportunities around the infrastructure and justify why they're COPing. Please correct me if I'm wrong. You would hope that at that stage there would be potential companies that would be looking to acquire those assets. But I guess, again, correct me if I'm wrong, I guess it all comes down to licensing, because ultimately, you know, the license could be revoked and handed to another company. So perhaps it would simplify the M&A process. And this is all high level. It's me individually talking, okay? But who would keep that platform running? That would have to be on the existing owner, wouldn't it? Not necessarily.
No, I don't want it.
No, you don't want it. Do you know? Is it?
A couple of clarifications. We
Yeah.
no longer have a COP process. So
Oh, do we not? Sorry.
COP process. Sorry, my name's Alistair Thomas, Decommissioning Manager of NSTA. So we retired the COP process in 2023, I think it was. Operators still are formally required to notify us of COP, but they no longer have to submit the dossier. So the Operations Directorate steward operators up to a COP. So we are cited to when COP is going to occur over a long time frame. So as long as there's no substantial changes to that through that stewardship process, we're satisfied that COP is going to occur at the right time, consistent with maximum economic recovery, consistent with emissions, environmental emissions, consistent with decommissioning readiness. So that's the vehicle we use for stewarding and managing kind of cessation of production now, as opposed to the kind of termination. The second thing to say, I suppose, is in consideration of decommissioning, one of the things that all operators are obliged to do, required to do, is consider alternatives to decommissioning before you get to COP. So as part of the kind of decommissioning glide path, part of our decommissioning expectations, there's an expectation in submitting a decommissioning programme that the NSTA, so that decommissioning programme goes to OPRED, obviously. We as NSTA are a statutory consultee on that process. One of the considerations that we think about and the operators legally obliged to look at is alternatives to decommissioning before they reach COP. So is there a merger and acquisition opportunity? Is there a carbon capture opportunity? Is there a new business opportunity, etc., etc.? The conclusion of all of that, and therefore what therefore falls out of that is what is the scope of decommissioning? Yeah, the licensees are responsible if they choose to cease production and not decommission. It is the licensees' cost. The licensees continue to pay the bill. So fundamentally, if an operator puts a facility into warm stack or into normally not manned, but still in existence, it's the ongoing ongoing partnership, operator on partnership that funds the bill associated with that. So, yeah, the bill remains with the operator and the licensees up to the point where it's decommissioned.
Yeah.
So, yeah.
Thank you. Thanks, Alistair, for that. That was brilliant. Thank you, Callum, for such an intriguing question again.
Right, we are going to take a coffee break. Please feel free to continue the conversation. Please be back here for 10:30. We'll start the second session and we'll have another Q&A session at the end of that. Thanks, everybody. Wonderful. Thank you very much. Welcome back to session 2. Hope you've enjoyed your coffee and semi-warm sausages. Don't say that often. Session 2 then. Just a quick things to point out. Anyone that's got purple badge on, our Westwood staff. We deliberately haven't put out more feedback forms today, overwhelm you with QR codes and forms and what have you. If you do have any comments or would like to be spoken to afterwards, just leave your card at the front desk, or Barry, shove your hand up for me. There you go, that's my badge, hold up. Thanks. Barry, you're happy to set something up to talk about any of the products at another time. So, session 2. I'm delighted to welcome up Teresa and Nick. Teresa is going to go first, and then we will finish off with Q&A afterwards. Just a reminder, you can submit questions via the QR codes or put your hand up. Thank you.
Okay, so for anybody who doesn't know me, I'm Teresa Wilkie. I work on the RigLogix product. So we track the offshore rig market globally. And today it's going to be looking more specifically at Northwest Europe and the UK market. So that will be obviously more focused towards jackups and semi-subs, so the two main rig types that work here. And I really want to focus more specifically on how the supply factors are going to affect decommissioning of wells in the UK sector going forward. But before we start, I want to touch very quickly on the global rig market and some of the trends that we've been seeing there. So really since 2021, we have seen a swift recovery in all three rig types or parts of the market globally. And that was, of course, bolstered by strong oil prices. So the average price of Brent crude fell 18% in 2023 to $78 per barrel versus 2022's figure. However, it remains sufficiently high to support healthy levels of rig activity and utilisation, which remained above 85% for all three rig types during the year. However, as you can see from the three lines there, 2024 has brought a dip in utilisation across all three segments of the market, and all for different reasons, really. So for drill ships, which is currently sitting at 91% committed marketed utilisation, which is actually a 6% decrease versus the same month in 2023, despite an increase in demand of 4% in the same period. So this is actually down to additional supply being brought into the market. So we've seen some new builds come in that don't have contracts in place. That don't have contracts in place, but of which we know are being bid into the market. For jackups, the utilisation there has softened 3% since October 2023, despite a 2% increase in demand. And that's actually due majorly to recent events in Saudi Arabia, where we saw the national oil company Saudi Aramco suspend up to 27 jackup contracts by up to 1 year, making all of those assets available for hire within the region, and also many are being marketed outside into different parts of the world as well. However, the majority of those suspended contracts will actually resume after the year period is over, which obviously means that backlog in place remains, and it's actually added to the back end of the contracts. However, committed utilisation hasn't actually been affected that much because the backlog is still in place. Those rigs have future contracts in place. However, when you take into account work and utilisation of the jackup fleet, that's been more seriously affected by those changes, and it's currently sitting at just 80% just now. Now, for the semi-sub market, the dark red lower line on the chart, you can see a sharp drop of actually 10% versus the same period last year. And that is mainly attributed not to higher supply like the other two parts of the market, because supply has actually continued to fall. And I'll talk about that in more detail as well in a little bit. But it's actually due to lower demand. And that's actually a lower demand of 6 units versus that same period. And I'll dive into that a little bit more in a moment. So globally, jack-up contracting activity, then you can see here from the chart that contract award activity in 22 and 2023 were particularly strong, and that was really led by high award activity coming from the Middle East. So a lot of the national oil companies there were really ramping up their rig fleets and their activity, especially Saudi Aramco. That, is highlighted by the dark blue segments if it's not easy to see there. However, of course, year to date, it really isn't a particularly great picture. And that is a 67% decline in award activity this year versus the same period last year. So that is, of course, due to a slowdown in awards coming from the Middle East, but also we saw delays in tenders being awarded in India. Also, some of the demand from Asia Pacific that we were expected to be awarded this year hasn't actually materialized yet. So it has been a pretty slow 3 quarters of the year. So although it looks bleak, there is a considerable amount of tenders outstanding in the global market, which I'll show later, including some recent and soon to be issued multi-year, multi-rig tenders, once again from India, and we're seeing some more specifically come from the UAE as well. So we do expect to see a busier 4th quarter. On the semi-sub side, quite a similar picture in terms of contracting activity this year, similar to the jack-ups. So you can see from the dark blue segments, which actually is Northwest Europe, which is, of course, one of the main areas of demand for semi-subs globally, and that it is really lagging this year. So year to date, awards from the North Sea have contributed just 27% year to date, which is particularly low for this point in the year. West Africa has also brought very little awards, following a slowdown in Namibian contracting activity. However, South America has provided one especially long-term deal, which has kind of helped to bolster the awards this year. Again, there are still a handful of tenders out in the market, which we believe could be awarded before the year end, which will help bring that total up. So some of those are coming from areas like Norway, Libya, Namibia, the Falkland Islands, Malaysia, and Indonesia, which could help that raise that 2024 figure. And just very quickly looking at drill ships, I know we don't have any drill ships operating in the area, so I won't dwell on this one for too long. But I wanted to show one area of the market that is performing really quite well this year. So award activity year to date for drill ships globally is actually already on par with 2023's comparable period. And we've seen a particularly high number of awards in the US Gulf of Mexico, also continued awards coming from Brazil and West Africa as well. And we expect demand to come in around the same level as the last 2 years as well for drill ships this year. Interesting to note as well that the average contract duration for drill ships is now the highest that it's been since 2014, sitting at 502 days currently. So contracts are also getting longer for this rig type too. Globally, day rates, so you can see from this chart that sort of satisfying horseshoe, or maybe not quite as satisfying for operators, but they've continued to rise really since 2020, following the pandemic, with drill ships and jack-ups now commanding the highest rates since 2014. Average jack-up day rates are sitting at $132,000 per day. And for drill ships, that's $473,000 per day. Semi-subs is the only segment which stands out this year with a 10% dip in average day rates versus a full year figure for 2023. However, that doesn't actually mean that we aren't seeing increases in day rates for the semi-sub segment. It's just that we've seen more awards for sort of lower specification assets, which has kind of brought that average down. All right, so diving into Northwest Europe market then, and starting off with the shallow water, the jack-up segment of the market. So this is a slide that I feel I have shown many times over the last few years. The figures might have changed a little bit, but the overarching story really remains the same. And that is falling demand, which you can see split out here in the columns by the different areas of the North Sea, so Norway, UK, Netherlands, and Denmark. And with that, we've seen falling supply as well. And so, sorry, the supply is that sort of grey area in the background, which I see now is actually not that easy to see, but there is a grey area in the background, and it falls in line with demand. Okay, so I'll take that on board for next year. And that is really the reason behind that high utilisation that we're seeing on the end there. So 96%, that looks like a really pretty healthy market, but that really isn't off the back of higher demand. That is more due to supply changing. So that supply has fallen through rigs exiting the region for work elsewhere, rigs being cold stacked, or rigs being scrapped. So across the four main areas of Northwest Europe, really the only area that has recorded an increase in demand this year versus last year is actually the UK North Sea. So that we've seen a 2-rig increase versus the same period. So that is a positive, despite the wider market recording declines. And then for the semi-sub market, a very similar story here to the jack-up side of things, in that we've seen that sort of steady fall in demand since 2014 that really hasn't been rectified, apart from a sort of a slight uptick in 2019 before the pandemic. And we haven't really seen a huge amount of recovery, especially when you look at other parts of the world where we have. So during the same period in 2023 versus today, we have recorded a 4-rig reduction in demand in North Sea semi-subs, and that's a 3-rig decline in the UK and a 1-rig decline in Norway. However, once again, that supply, which if you strain your eyes, you can really see, has also fallen in line with that demand drop. So that's resulted in, again, utilisation looking fairly strong at 91%. And it's remained at over 90% this year. However, the UK figure is a bit lower than that, actually currently at 88%. So we have one unit that is stacked without any future work in place, and another that is stacked that does have work starting next year. So where have all the North Sea rigs gone then? You can see here that between 2015 and 2024, 18 rigs have left the market for work abroad. So that's 11 jack-ups that have moved to South America, Asia Pacific, the Middle East, and Eastern Europe, to name a few, while 8 semis have been tempted away during the same period to areas like West Africa. So we're seeing quite a few units go to Namibia, to India, and to Asia Pacific as well. And of course, there is potential threat of more units leaving in the future. So you can see here that there is considerable demand for semis and jack-ups worldwide, especially so when you compare it to what's available in the region in here. And generally, those tenders as well, from the bottom chart, you can see those tenders that are outside of the North Sea are of longer duration. So likely more appealing to North Sea-based rig owners as well. So we could potentially see more units leave. So in addition to rigs leaving the region for work abroad, we've also been seeing high levels of older assets being permanently removed from the fleet through scrapping or being converted for other purposes. So several third and fourth generation mid-water semi-subs, which are very commonly used for plug and abandonment work in the UK North Sea, as well as older sort of standard class harsh environment jackups have also left the fleet. And again, those units historically have been well utilised for plug and abandonment campaigns. They're smaller and often cheaper to hire as well. So you can see from the left hand chart that since 2015, 52 units have been permanently retired from the fleet, from the North Sea fleet, I should say, and just 30 new rigs have been brought in the and the last one was actually added in 2019, so quite a while ago. And to note, almost all of the new builds that have been brought in are actually have actually been put to work in Norway, so not for use here. And on the right-hand chart, you can see the age ranges for those assets that are remaining active in the fleet and in the region today. So there are several jackups and semi-subs in this sort of older range here, which obviously are quite a bit older. Several of those are still working and have long-term contracts in place. But I think the concern is if we do see demand fall away anymore, we see some of these units become idle, how long will they be kept warm or cold before potentially those could be moved to the scrap heap as well. So looking specifically at Northwest Europe award activity then over the past few years, starting with jackups on the left-hand side. You can see that the recovery started well in 2021, but fell year on year through to last year. Though we are seeing a slightly stronger we're in Q3, a slightly stronger 2024, especially for the UK, which is the orange bars in both charts here. So far, the UK has already achieved a higher award activity than the full year figure for 2023. However, Norwegian demand, as well as Dutch and Danish additional demand, has really struggled this year, especially when you compare it to the 2017 to 2022 period. And then meanwhile, on the right-hand chart, which shows semi-sub awarded days, 2024 really looks quite worrying. It's been a particularly sluggish year for both Norway and the UK in terms of new demand. And I'll touch a little bit on what's outstanding in the region as well, and just in a moment. All right, so taking a look at rig day rates in the region then, and starting with jackups again on the left-hand side. So jackup rates since 2021 across the region have been increasing. And if we look specifically at the UK, which is, again, the sort of light orange bars, average day rates for contracts fixed this year are sitting at $135,000 per day, which is the highest recorded since 2015. So despite that demand decreasing, the supply decrease that's come in line with that has helped to balance out the market, which has resulted in costs to hire a rig increasing. Meanwhile, on the other side of things, the semi-sub market in the UK, which, if I remind you, is currently sitting at 88% utilisation today. And there is, and I mentioned already that there's two units currently idle. So this segment has actually recorded decreasing average day rates, which is really quite unusual, especially when you're taking the global market into account. But of course, if you look at 2024's figure, there have been so few new fixtures made this year, it's quite difficult to actually benchmark. So this average for 2024 is based on just a handful of fixtures, and one of those was specifically very low, which has obviously brought that day rate down. Just now we're seeing bidding in levels for your sort of third or fourth generation units at sort of 220 to 260 for work starting in the first half of next year. And then, of course, you can see on the flip side of this, which is really quite different, the typically sixth generation harsh environment semi-market, which is really led by Norway. So that's the the dark blue line there. So you can see that they're now commanding day rates close to 500,000 a day. So the average is, I think, currently at 480,000, which is really due to so many rigs in the world, so many of the sort of highest spec rigs in the world operating there. As well, of course, higher operating costs in Norway compared to other places in the world as well. But really very strong rates coming out of that region, despite some of the lower activity we've seen this year. All right, so I've mentioned award activity so far, and how that's been, really quite worrying at the moment. But there is some demand outstanding in the market for campaigns starting from 24 through to 2026. A number of these we could see awarded before the end of the year as well, which would, of course, be a welcome relief to some of the rig owners. In terms of plug and abandonment work, this accounts for 43% of all demand currently at the tender or pre-tender stage today. At the beginning of the year, however, there were several more multi-year campaigns or tenders for campaigns that had been expected to tenders and some that had been expected to reach a tender stage, which unfortunately slipped away. They were either deferred into sort of 26, 27, or they've kind of just been shelved, they've disappeared. So, this sort of delays coupled with very low exploration and appraisal, which Yvonne mentioned earlier, and also uncertainties with some of the development demand there looks pretty healthy as well, but there is a lot of uncertainties behind some of these. So a number of these are just at pre-tender at the moment. So I think there's still a lot of operators waiting to see what happens with the budget, what's going to happen with these developments, are they going to move ahead? So there is a little bit of a worry behind some of those as well. So because of this, unfortunately, it means that we have seen, and we do know of several of the UK-based drillers, rig owners that are currently bidding their rigs outside of the region, just because the demand outlook is really quite cloudy at the moment. So bringing it back specifically to the plug and abandonment and decommissioning side of things, then on the left-hand chart, so this shows the number of rigs that have been operating in Northwest Europe on plug and abandonment activities since 2015, through to the end of this year, actually. So typically there has been an average of around 10 rigs working on P&A campaigns in the region each year, the majority of which were actually in the UK sector. Now, if you look at the right-hand chart, which will hopefully look familiar to you, presented by Yvonne earlier, if we take into account that sort of impending increase in inactive wells, in addition to those already needing to be P&A'd, the number of rigs needed to undertake that amount of work is going to obviously increase and not decrease. So it's a little bit of a worry, especially with what I've kind of shown already in terms of rigs leaving the market. So what's the outlook for the jack-up market in the region in the next few years then? The grey area shows supply, and that is already set to fall. Okay, you can barely see that again. Sorry about that. There is a grey area, and it's falling. So that is set to fall again next year. So we're going to have another unit leaving the region. However, we expect a 2-rig increase next year in demand in the 2025 and 2026 period, which is obviously going to keep utilisation high. In turn, we're forecasting further day rate increases for harsh environment jackups globally and within the region. And this forecast shows figures, this forecast here shows figures for all harsh environment units. So this is not just looking at the North Sea. So you'll see that we have day rates currently sitting at a high of $180,000 per day. That's not for North Sea-based units. That was actually for a harsh environment unit that went to work in Australia. So there are obviously a range of different day rates depending on where the rig is operating and the duration of the contract, things like that. But yes, we believe that that sort of tight market that we expect to see going forward is going to continue pushing day rates up for this rig type in the region. And then just finishing off with the semi-sub outlook for the region then. And similarly to jackups, we've seen that falling supply. And though currently no more rigs are set to depart the region yet, there is the threat if we don't see more tendering activity in the market to keep the rigs working here. As I said earlier, the UK market, which is now made up of less than 10 units, and due to their age, some of these obviously could be up for retirement if they aren't put out to work. In Norway, the threat is somewhat less due to its modern fleet of high specification assets, as well as a few situated elsewhere in the world that could be attracted back to the region if, by higher day rates, if some more requirements are to appear. Day rates for semis in the UK sector, which struggled to barely reach $200,000 per day over the past few years, could quickly head north if just a handful of new long-term requirements come out. So that could be P&A, that could be development, whatever. But if they were to come to the market, due to the now very depleted fleet, and obviously there's the risk of more units being retired as well, those day rates could move up very quickly if more rigs are to leave. So if there is spare tonnage in the Norwegian fleet, some of these units could be utilised within the UK market, such as the West of Shetlands area. But for a lot of the planned plug and abandonment campaigns that we're seeing in the UK, these rigs will be, the wrong specification. They'll be very expensive to hire as well, so probably not a very good alternative for a plug and abandonment campaign. Therefore, really, it should be of high importance to operators with P&A work to do to hold on to these assets, especially the smaller sort of mid-water UK-based units, to be able to secure the right assets at the right price for their future campaigns. So that's me covered out the rig market. So thank you so much for listening, and I'm going to pass over to Nick, who's going to run us through the field development and vessels.
Thank you, Teresa. So, I'm going to talk to you a bit about the subsea equipment and field developments. So, field investment decisions is one of the metrics we use in gauging industry health. So, as we've said, kind of despite Brent crude oil prices being slightly above last year, we only recorded 26 FIDs this year, which is actually far lower compared to the past 4 years, including during the height of the COVID pandemic in 2020. And it's also starkly different to our start of the year optimism, where we were forecasting 80 FIDs. And it includes some major UK projects. We have Avalon, Ping Petroleum, as operators grapple with some of those increased costs that are kind of well discussed. So the chart has FIDs there on the left, and then some of the upcoming FIDs, as well as some of the upcoming awards in the subsea space. We have fixed production systems and subsea trees. So moving along to discuss a bit more about the offshore spending outlook. So looking at this year alone, $37 billion has been spent against probably $60 billion we're looking at for the year for 2024, which is actually 43% higher than last year, despite that decline in the number of FIDs. That kind of yawning gap that you see between the FID count and the spend can at least partly be explained by the aforementioned inflationary challenges. Some of the major ticketed items like Shell Sparta's FPS unit, and is also impacting some of the upcoming FIDs. Globally, Eni's Coral in Mozambique, and also the Pekin project as well in Ghana. So looking ahead in terms of the numbers here. So in general, it's been a pretty good few years for the conventional oil and gas sector spend-wise. Obviously, we've mentioned that these projects will compete for the same kinds of assets as, for instance, offshore wind, and for decommissioning, importantly, as well. But I think we've kind of mentioned this already, but the kind of number of FIDs has been quite low in the UK. We anticipated 8 this year, but we've only had actually 2. And there have been quite a few large projects, Hartshead's, Anning and Somerville, and then you've got Enio's Buchan yet to be sanctioned. So moving along, we track the kind of full spectrum of subsea equipment. This includes pipelines. So we've got on the left chart rigid and fixable pipeline, kind of hindcast and forecast, so looking back and ahead. And on the right-hand side, the number of subsea trees, so kind of trending up for both. We also track fixed and floating installations. Just to let everyone know, the slides are going to be shared, so no need to take too many photos. But yeah, so again, trending upwards, certainly for fixed platforms. And also, if we look a bit more at the decommissioning space, so these are actually captured within our subsea logics and platform logics market intelligence tools. We have analysts tracking them daily, and they're plotted out. And one of the things we found is over the past 18 months, the number of decom contracts has kind of surged in west of Shetland and the Northern North Sea compared to the Southern North Sea. We've kind of alluded to it already, but one of the reasons for that is the Southern North Sea has the potential for some CCS enablement. So there's smaller assets there that are being considered. The more northern assets tend to be larger and perhaps a bit less affected by some of the macro changes. In terms of the outlook for the next few years, so we're expecting around 80 fixed platforms will cease production by 2028, and at least 15 UK decommissioning contracts, which includes Repsol's Fulmar and Oak and Shell's Brent. Now, if we look a bit more at the wider supply chain, so what we've done here is we've just mapped out the primary assets that will support decommissioning in oil and gas, but also these assets can support offshore wind. So we've really got a view of a project as it evolves in offshore wind and oil and gas. So just run through these quickly for the uninitiated. So remotely operated vessels, service vessels, they support both oil and gas and offshore wind, tend to be quite large. And there are around 160 of these globally in service, with several on order just now. The asset class has an average age of around 13 years. The next class down is the diving support vessel, DSV. These support physical divers going into the water. Saturation diving is generally required beyond 40 meters underwater, which is pressurized environments traveling between the vessel and the seabed through diving bells. These are larger vessels with twin diving bells, and there's about 58 of these active globally, with an average age of 16 years. The final class, HLV heavy lift vessels, are very large. Cranes can range from 1,000 metric tons right through to 15,000 metric tons, and they're used for installation and removal of oil and gas, and increasingly offshore wind installation campaigns globally. There's 59 of these, and they are stratified by their classification, so you get different specification HLVs. New builds cost about $1 billion US. We haven't included here wind turbine installation vessels, which some consider falling under HLV category, but they're quite focused. They are self-elevating, self-propelled offshore wind farm vessels, which have the potential or could apply to offshore oil and gas decom. So these three vessel asset classes, we track these asset classes along with the other asset classes: anchor handling, tug and supply, the whole support offshore vessel fleet daily. And we've got a look here at some of the recent trends in terms of number of days they have been contracted, and also the utilisation shown in green on the chart here. So first one we'll discuss is ROVSVs. So they've obviously been in demand in the past few years. Those operators have had an uptick in backlog levels and also, importantly, profitability. And in terms of looking ahead, so we're seeing the potential for those to hit probably 95% utilisation by 2028. That's ceteris paribus, everything being similar as it is now. So that has a potential supply crunch. Next along, we've got DSVs. I'll maybe skip along to HLVs because there's been quite a few recent contracts that particular vessels have worked on. Sleipner was at Brent in 2020, and Pioneering Spirit was at Tyra 2020 to 2022, and Saipem 7000 was at Heather. Apart from the North Sea, these assets tend to work in harsh operating environments, so likes of Canada, Latin America, and this asset class, so it's had around a 20 to 40% utilisation rate in the preceding 5 years, but that's going to really ramp up in the upcoming years, not just from European oil and gas decom work, but also increasingly, as we said, the offshore wind work. And particularly so as the substation size increases, we believe this is going to be a large potential market for the higher spec HLV vessels. Recent awards include the Pioneering Spirit and Sleipner working at Tennant's offshore wind farm. It's important to note as well, just on that last point, so one of the extrapolations that we've done based on our current understanding of the fleet and the new building capacity is that we're seeing a scenario where it's possible that the number of units able to support offshore wind will be quite significantly less than the number that are required. So really kind of demand outstripping supply by 2030. This last slide here, so we'll just quickly talk about the net vessel movement. So that's vessels either coming in or leaving the North Sea since 2021 to today. ROVSVs, there's been a lot of movement with these kinds of vessels. They've kind of come in from every continent to the North Sea and also left from the North Sea to every other continent. Particularly Latin America, 6 vessels came in, 11 left the North Sea for Latin America, and Asia. So 5 vessels came in from Asia and 4 ROVSVs left for Asia. One of the recent examples was the Botnica, which was supporting the Mungo field in North Sea, BP's normally unmanned installation. We believe that asset is still active there. And also the Edda Sphinx, which was mobilised by, apologies to anyone Norwegian, Ostenji Rederi, or Italian, I'm not sure, which is reported to have secured contracts in Norway supporting the Northern Lights carbon capture and storage project. So that's actually working at laying some of the pipelines for transportation of carbon dioxide. Next along, if we quickly talk about diving support vessels. So one of these vessels entered the North Sea from Australasia, and another came from Eastern Europe, but then another left for Latin America. The Deep Arctic is in Norway, supporting Equinor and Technip FMC for underwater operations. HLV, so both of these vessels came into the North Sea from Asia. Again, apologies to French people, Les Alice travelled from China to Netherlands, being delivered in January 23, and is going to perform her first work scope in Germany for Ørsted's Gode Wind and Borkum Riffgrund offshore wind farms. And just another note on Asia. So there's a lot going on, obviously there, centre of demand for a lot of things, including installation, a lot of demand for these vessels from, for instance, India. The national operator ONGC is ramping things up, but also importantly for decommissioning, particularly if we look at Southeast Asia. And we know the population of offshore platforms there is significantly higher. It's a larger volume of assets, but a lot smaller and perhaps less complex and in shallower waters. And there's an argument that these assets are being driven by different factors, including project economics, as compared to regions like the North Sea. However, if you look at Petronas, which is the Malaysian national oil company, they said in one of their more recent investor releases that they were looking at a significant increase in the plugging and abandonment activities this year to one of the commitments by the regulator. Last year, they plugged 28, they were planning to plug 28 facilities, but 45 were decommissioned. Very unusual for Petronas to go quite a bit above what it said it will do. And it's planning 137 such campaigns between now and 2026. Aligned to that, a lot of the companies that are local and active here in the UK and the North Sea are setting up base. So Sescon has set up a supply base in Southeast Asia, and Wood, which is obviously relevant for this hotel, is doing a lot of work with Shell Brunei as this phase of their oil and gas sector develops. And just the final point as well on the supply chain. So particularly if you look at the marine sector, there's been quite a lot of recent consolidation. So this year alone, Edison Truist, the American vessel firm, acquired Rovop in May. July saw the Norwegian firm DOF acquire Maersk Supply for 1 billion, most of it through debt. And then in September, we saw Rovco tie up with Varst to become Beam Global, which is going to target exclusively offshore wind, and post-merger will be hiring quite a bit in Asia. If we just turn to some conclusions on the second half of our presentation. So really what we've seen is a slowdown in global semi-sub and jack-up demand this year. The drillship market remaining reasonably healthy, as Teresa said, not so relevant for the North Sea. The wider kind of supply in northwest Europe will fall in line with decreasing demand, although further departures are expected or scrapping. And there's a lot of P&A demand coming in the next few years with very few assets capable of doing that kind of work, which has the potential, obviously, to increase supply chain and ultimately taxpayer cost. And a few final points. So I think there's been quite a resurgent offshore energy sector in the past few years. Certainly there's been some muted sanctioning recently. And the kind of challenges of the past few years, myriad though they are, have meant that there's been higher spend in the supply chain, which puts greater pressure on the supply chain. And also supply chains internationalizing, so a lot of suppliers moving out of the region or perhaps staying in the region and selling more in international markets. And the last point just to make is that the three asset classes that we've mentioned, so they're applicable not just for decommissioning work here in the North Sea, but also decommissioning work elsewhere and increasingly for offshore wind campaigns. So we'll leave it there to wrap up. We'd ask for any questions, but make them easy, please.
Thanks, Nick. Thank you, Nick. Teresa, if I can just ask you just to pop back up. We've got a few questions for you, and perhaps Yvonne and Glenn, if you'd also like to come back up. Always one. Right, a couple of questions. I think, Teresa, bear with me one sec. Teresa, for rigs then, Why is Norway jack-up day rate so high in comparison with the UK and Northwest Europe?
Yeah. So for jack-ups and for semi-subs in Norway, they are generally much higher. So first of all, in comparison to sort of operating costs, you're looking at least 20% higher versus like what you would pay in the UK. So that obviously is taken into account in a day rate. But also in Norway, jack-ups specifically is a very niche market. There's only really a handful of units operating there. There's only a handful that are operating there and that can operate there, that are Norwegian spec to work there. So those few rig owners that have units that can work there can kind of, charge not what they want, but charge quite a bit more for their assets. They're also some of the most sort of premium, high specification assets as well. So it's all those factors that come into it, and it's very similar on the semi-sub side as well.
Great, thanks. I'm going to tack across just because you sat down. Yvonne, what is the potential for companies to cooperate on decom activities to make it more efficient?
Can I grab a mic? Share yours.
Yeah,
Sorry.
go for it.
I feel like I'm comfortable. I'm going to use that word. Can anybody guess what it is? Begins with C. Shout out.
Collaboration.
Whoa, well done that, man. Yeah, it's great, isn't it? They could talk to each other, and really talk to each other. Talk to each other, get around the table, work it out. Plus, there's a lot of companies that are offering to do it. So if the operators can't get in a room and join together to work out, well, my platform's expected to cease in 2028 and mine's is in 2029, we both need a jack-up. How about we share the contract? It's not really a light bulb moment, but it seems to be in this area. Does that answer the question? Talk to each other. And if not, there are other companies, there's a lot of third parties who are now providing and looking to provide the fait accompli in terms of decommissioning services, and they are talking to all of the operators and may be an alternative option if you want to go down that route.
Thanks, keep hold of that mic.
Okay. Get out of the way.
Stay put. I've got another question for you, but if anyone has questions in the room, please put your hand up and myself or Alex will come round to you. Next question, and then I'll come to you, Teresa. How much will the CS business impact on the decom programs?
Is this for me again?
Yeah.
Carbon storage. It's going, well, careful what I say now. It's a viable option. It will come, but there is a huge, not huge, there is a lot of uncertainty in terms of, we know it's needed, we know it's coming. We don't know how big the CS business is going to be. We don't know how quickly it's going to come, and who will be embracing it, and who will be paying for it ultimately. Because it ultimately has to be a business case. Logically, the furthest progressed are at the moment in the East Irish Sea, in the Morecambe Bay area, looking at the Southern North Sea sector. Pretty much dry gas regions, reservoir aquifers, fit for purpose in terms of accepting the storage, the infrastructure's there. How big a business piece the CS is going to become will probably determine how much infrastructure is going to need to be decommissioned and what's going to be repurposed. So a little bit of an unknown. Central North Sea, Northern North Sea, more challenging from an equipment side. I'm not a reservoir engineer specialist, but again, you've got the likes of Enquest who have gained some licenses in the latest carbon storage round, looking at repurposing some of the East Shetland Basin infrastructure. It's a big unknown, but will it impact the overall decommissioning piece? Probably not hugely, in my opinion, at this stage.
Thanks, Yvonne. We've got one from the floor.
Yeah, hello. Do you think EPL will accelerate actual decommissioning spend or kick it further down the road?
Challenge. If there wasn't guidance in place from the NSTA, and they have guidelines. Alistair, correct me if I'm wrong on this one, please. And the stewardship process, that companies should be endeavouring to minimise the costs of decommissioning, and part of that will be not kicking the can down the road, so to speak. That said, decommissioning costs cannot be offset against the EPL, can be against SCT and corporation tax. So companies are looking at offsetting their operating costs with the abandonment. And if you're looking at 40% tax, offsetting a 40% tax versus a 78% tax, it's another can, if that makes sense. So, should they be doing it? No. Will they do it? Couldn't comment. It's a realistic piece and dilemma. Does that answer it okay? It's a very difficult question again.
Thank you. Any more from the floor? Yep, gentleman at the back.
Jim Cargill from Plan C here. If I could just pick up on something Yvonne said there, and it's not so much a question as a general comment, and we'll come over as a shameless plug, but that's just tough, I guess. We have developed AI-based optimization software we're applying to marine logistics. We're now in the very early stages of working with an organisation here in Aberdeen to look at optimization of subsea decommissioning projects. If anyone wants to talk to me about this, I'd be delighted to talk to you afterwards. Thank you.
I think, do we get to charge you commission for that plug?
Anyone else have a question? Teresa, I think we'll be finishing with you then.
Okay.
How can we get operators to tender for rigs when the work is continuous, long-term in nature, direct continuation, and all vessel and wellhead work is complete?
That's a very good question. Well, I think, obviously you can't force an operator to come out with a oh, yeah, am I not on? No?
Yes.
Oh,
there you go.
Yeah, you can't force, that's it, yeah. You can't force an operator to come out for a long-term piece of work that they, for a rig that maybe they don't need. But what we have seen in the past, of course, is rig share campaigns. So I know some operators might cringe when you say it, because I know there's a lot of challenges that can come with that. But certainly when you look at the way the supply is headed for rigs that are capable of working in the UK North Sea, it may well come to having to look at solutions like that, where a couple of operators get together, combine all the work that needs to be done, and then they share a rig or two. So yeah, I think that's probably all I have for that. Yeah.
Okay, I think we are done. Does there have any last minute questions? Right, everybody, thank you very much. Just a quick hand, please, my colleagues, put a lot of work into it. Just to finish up then, recording will be available probably next week. Everyone in the room today will get a link to watch it, along with, I believe, a copy of the deck, let you know that confirmed. If you have any feedback or you want anyone to follow up with you, just leave your card at the front desk. We are here for another 5-10 minutes. Feel free to finish off whatever's left, but we have to be out of the room by 12. If you're still here by then, you're helping us pack away. Thank you very much. Hope you enjoyed today. Goodbye.